sharing experiences, and now that it is very fashionable to talk about if you have a surplus or a deficit, I have to say that Banco de Mexico has a deficit with Bank of Canada in terms of knowledge transfer and know-how and basically good advice. I was mentioning yesterday, Steve, that in many aspects, Canada is some years ahead of Mexico, at least speaking from the monetary and financial point of view. Canada was one of the very early adopters also from a world standard or from a world point of view of a flexible exchange rate regime. That was for a small open economy quite an event, and as Steve mentioned to me, even the IMF scolded them for not sticking with the fixing exchange rate regime. The transition was smooth because, as different from Mexico, where we had to abandon our fixed or our regime because of pressures on our exchange rate, they were having pressures towards appreciation. So, of course, that makes it for an easier transition. But given the fact that they were one of the first adopters of a flexible exchange rate regime, they had also to figure out what would be an adequate monetary arrangement to anchor inflationary expectations. And after going for a brief period of time targeting monetary aggregates, they were also one of the pioneers of adopting the scheme that now is used by many countries, which is the inflation targeting regime. And well, so with I don't know, probably more than 20 years behind them, we moved to a flexible exchange rate regime, and they moved into an inflation targeting regime in the early 90s, and we moved into it until 2001. So, of course, in all this, it was always handy to pick up the phone and call our good friends in Ottawa, and they were always they always have been extremely happy to share their knowledge, their points of view, and so on. And the collaboration has been going all along in many different areas. For example, in payment systems, they also were a very good inspiration for us in terms of how to develop our large volume payment systems and our retail payment systems. As a matter of fact, SPAY, which is I think one of the best payment systems in the world, in a way its origin started with some ideas that were shared with us by Bank of Canada. And of course, during the last years, we have had also very fluid communication. Both of our countries have managed to resist or show resilience in the face of the global financial crisis. As central bankers, we have made use of very limited unconventional monetary policies. Growth is there. And well, that doesn't mean that we haven't faced challenges. it was not only the global financial crisis, then we had the problems in Europe. Then we had the collapse in oil prices, where there is another thing in common. And more recently, we had the result in the US elections that also represent a challenge that hopefully we will find the way to take that as an opportunity to enhance the integration with North America. So again, for Banco de Mexico, it has been one of those fortunate alliances that we have had with the Bank of Canada. It's an alliance that started far before my term in Banco de Mexico. And another very important thing that needs to be underlined is that with no exception, Bank of Canada has had outstanding governors. And needless to say, Steve Poloz is a really outstanding governor who has served his country extremely well, both in different fora and also on a bilateral basis. He has made very, very important contributions to our debate and our understanding of different subject matters. Steve has not only a great knowledge about monetary policy and exchange rate determination, theoretical knowledge, but he also can talk very freely about and confidently about fiscal policy, about trade policy, where he also has the background of having been the president of Export Development Canada. And by the way, in that role, he visited Mexico several times, and he certainly was a very strong promoter about trade between our two countries. So, you know, he's an extremely complete economist. Another very good thing, and I'm sure you will notice it through his presentation, he's one of the few central bankers that has a very good sense of humor. And so that's the cherry on top of the pie. So, you know, for Banco de Mexico, it's a real honor to have him here. We spent pretty much the whole day yesterday comparing notes, having a frank, candid conversation about particular problems that or challenges that we face, and challenges that we face in common. And well, I think it was certainly an extremely good idea to bring him to this event here today and share his views with this broader audience. So before giving the floor to Steve, I want to thank the ambassador for his collaboration, Armando Ortega, and the Club de Industriales, which today is professor. So anything I haven't learned, but it's also great to be here with very important friends, with Francis Suarez, who was our ex-ambassador in Canada, with the Subsecretary, Ambassador Sada, Marcos Martinez, Enrique Zorrilla, and many other, Andres, many other friends. Carlos Mena, who I have also to make a particular mention to him. He's the head of the investigative unit in the antitrust commission, and he has those tremendous work in the financial system to strengthen the integrity of it. So we fully support the work he's doing. So thanking you in advance, Steve. It's a pleasure to have you here, and the floor is yours.
Well, thank you very much, Augustine. I could just sit here and enjoy that all day, but it's time for me to do my work. I want to thank you all for being here this afternoon, and for, once again, all of the famous Mexican hospitality that I've enjoyed the last 2 days. Always enjoyed my visits here, and it's no different. It just gets better and better. Well, I'm really grateful to have the opportunity to speak to you today, because it's a really good time for our two countries to be talking. And it's true that nobody will ever confuse Mazatlan with Manitoba, particularly in February. But it's also true that Canada and Mexico have more in common than is usually appreciated, especially on the economic front. Now, a good deal of our commonality stems from the fact that we're both relatively small, open economies. We trade heavily with the economic powerhouse next door, the United States, but we share a lot more than just a common neighbor. Resources, especially oil, are an important part of both of our economies. The automotive industry plays a vital role in both of our manufacturing sectors, along with high-tech manufacturing, such as communications equipment and pharmaceuticals. And while we might be at different stages of our economic history, we're following a same trajectory. In both countries, the service sector today makes up the majority of output, more than 60% in Mexico, 70% in Canada, and those shares continue to rise. And, possibly most important, we are both committed to rules-based free trade, and we maintain a floating exchange rate within an inflation targeting framework for monetary policy. Now, since we have so much in common, it's not surprising that shocks in the global economy tend to hit us in similar ways. And today we are facing similar economic challenges. And more importantly, we have similar opportunities that we can capitalize on by using our strengths. So today, what I'd like to do is discuss recent developments in and prospects for the Canadian economy, but to do so in a way that I hope will resonate with the audience here in Mexico. So let's start by just going back a ways to the second half of 2014 and the collapse in oil prices. Now, various oil benchmarks saw declines of more than 50%, as is well known. Now, given the importance of oil to both Canada and Mexico, this shock represented a serious blow to our economies. It had a substantial impact on what economists call the terms of trade. That's the ratio of the prices you get for your exports relative to the price you pay for your imports. So in Canada, the terms of trade fell by roughly 11% in the middle of 2014 through the early part of 2016. And to put that into figures that you can appreciate more, this meant a pretty significant hit to our national income, about $70 billion per year drop in income in that period. That's roughly 3.5% of Canada's annual GDP. That's the loss of income. Meanwhile, Mexico's national income declined by about 500 billion pesos, or 2.5% of annual GDP. Now, in response to the shock, both of our currencies depreciated. Peso dropped by 28% against the US dollar during the same period, while the Canadian dollar declined by around 20%, so not so different. Of course, a certain amount of depreciation is not surprising. It's a natural consequence of a shock like this. In fact, this is why central banks have flexible exchange rates. It's for conditions like these. And it helps economic adjustments take place by sending signals that prompt shifts in investment and employment decisions. Now, although both currencies rebounded earlier in 2016, the peso then began to fall some more, while the Canadian dollar more or less stabilized in that area. probably global capital flows were an important factor to this distinction. Historically, flows in and out of Mexican capital markets have been closely tied to investor sentiment about emerging markets more generally. Capital flows into Mexico fell sharply in 2015 and remained low in 2016. Of course, at the same time as the Federal Reserve was preparing to raise interest rates and eventually began tightening monetary policy. So this put additional downward pressure on the peso on top of the pressure coming from lower oil prices that both Canada and Mexico were facing. Now, in terms of real output, though, the oil price shock hit Canada harder than Mexico. The Canadian economy contracted outright in early 2015, while growth in Mexico remained fairly stable. Now, this reflected in part the fact that Canada is a bigger oil producer than Mexico is. At the end of last year, Canada's output of oil was about twice as much as Mexico's. But for Canada, the oil price shock meant a significant shifting of capital and workers out of the oil and gas industry. And what it did in Canada was it established a two-track economy. While the non-resource sector continued to expand, it was not enough to offset the sharp decline in the resource sector. And from the start of 2015, the negative impact of the resource track dominated in our figures. So while the adjustment process in Canada has been very complex, very difficult on a personal level for many people, we are seeing encouraging signs now that the worst may be over. Activity and investment in the oil and gas industry have stopped declining and are coming back to a level that's commensurate with current oil prices. And because that large negative force is now essentially past us, it's no longer masking the sources of strength in our other sectors. So there's still a ways to go, but the two tracks of the economy are gradually converging to become a single track of sustainable growth. Now let me say a few words about monetary and other policies, noting that Canada was, as Augustine mentioned, a very early adopter of both aspects of that framework. Now, we experimented first with a floating currency in the 1950s, but then we fixed again for a while. And then we allowed the dollar's value to be set in financial markets starting in 1970, and we haven't looked back. Mexico moved to a truly free-floating system in 1994, somewhat later. But in terms of targeting inflation, Canada adopted that in 1991, which is about 10 years before Mexico officially did the same. Now, I mention this only because the experience of central banks worldwide now is that inflation targeting builds credibility and improves an economy's resilience to economic shocks. And the longer that this policy framework is in place, the greater this impact becomes. Now, there's no doubt that the predictability and certainty that come from inflation targeting helped Canada's economy to respond as quickly as it has to the oil price shock. And the response demonstrated our economic resilience and flexibility, certainly when compared with oil shocks in the past. Now, I don't mean to dismiss how difficult it's been for many individuals, but at the aggregate level, the economy has shown its ability to adapt quickly, and much more quickly than in past episodes. Other structural factors, such as Canada's relatively flexible labor market, have also contributed. Now, Mexico's inflation targeting framework helped make its economy relatively resilient to the shock as well. And in fact, it's worth noting that since experienced in past decades. Mexico's tax collection has improved. It's made notable progress with many other structural reforms. And while some of these may have been politically difficult, for example, the measures to open the oil sector to private and foreign participation, they've been important to increasing Mexico's resilience and competitiveness. Now, in both countries, framed the monetary policy response. Now, recall that the oil price shock led to a contraction in Canada's economy, while in Mexico, growth continued but at a slower pace. The drop in income caused by the shock in Canada raised the clear risk that Canadian inflation would fall below the Banque du Canada's target. So, in 2015, we lowered our key policy rate twice to help offset this fall in income and, of course, to facilitate the adjustment from resource industries to the non-resource sector. Now, by the end of 2015, the U.S. Federal Reserve began to normalize its monetary policy, and it's raised its key policy rate 3 times amid strengthening U.S. inflation and a labor market that's near full employment. But in Canada, given that core measures of inflation have drifted downward in recent quarters and slack in the economy and the labor market remain, we've kept our policy interest rate unchanged. Importantly, longer-term expectations of Canadian inflation have remained anchored throughout at 2%. Now, Mexico's experience has been somewhat different. The oil price shock, as I mentioned, was less of a downside threat to the inflation target. In fact, the greater depreciation of the peso led to concerns about upward inflationary pressure. So the central bank has tightened policy by a total of 350 basis points. This was to counter inflationary pressures, as well as to ensure the impact of the exchange rate would not de-anchor inflation expectations. Now, as I said earlier, the worst of the restructuring in Canada's oil sector appears to be over. A natural sequence to take hold. It would start with stronger global demand, and that would lead to stronger exports. The depreciation in our currency would support gains in non-energy exports. And all this would spark increased business confidence and business investment, which would, of course, increase growth and ultimately bring about that transition and bring the economy back to full output with inflation sustainably at target. Unfortunately, this sequence is yet to play out. A major part of the problem has been a continuing shortfall in Canadian exports relative to what one would historically expect given these other events. We've examined this very closely and found that both the permanent loss of export capacity that started more than a decade ago and ongoing competitiveness challenges for some of our exporters are playing the key role. And now we have yet another challenge to deal with, and that is uncertainty about the future of U.S. trade policy. For both Canada and for Mexico. Both of our countries' trade is dominated by the United States. Last year, fully 75% of Canada's goods exports went to the U.S. market. For Mexico, the number is even higher, around 81%. Similarly, the biggest share of both of our imports comes from the U.S. So these numbers reflect the traditionally open trading relationship among the three neighbors. So this uncertainty has real consequences for real companies. It increases the risk the companies face. That can raise their cost of capital, and it can restrain investment. The bank's most recent survey, our Banque du Canada's most recent survey of Canadian companies, showed that many see negative risks from potential U.S. policies. These risks include increased protectionism, reduced competitiveness of Canadian firms if U.S. corporate tax rates are lowered, possible delays in implementing pro-growth U.S. policies. To be clear, the outlook for investment in machinery and equipment in the bank's Business Outlook survey has continued to improve. But many companies are saying that they are just maintaining or modestly increasing the level of their investment spending. Some are also saying that this spending will be limited to maintenance work rather than the type of expansion that natural sequence that would support economic growth. And when you consider the painful memories of the global financial crisis and the recession that followed that are still fresh, it's not surprising that companies would continue to hesitate to expand in the face of this uncertainty. This situation has similarities in Mexico. Both producer confidence and investment intentions fell after the U.S. election, reaching their lowest levels since the global financial crisis. And in concrete terms, we've seen several announcements by companies in the auto industry to cancel or to delay plans for major investments in Mexico. The picture is certainly not uniformly poor, and we've seen auto companies based outside the U.S. announce plans to invest in Mexico. Still, the ongoing uncertainty represents a clear challenge for both of our countries. So this naturally leads to the question of what can be done. Well, any economist, and I mean any economist, will tell you that open trade supports economic growth and employment. We know the predictable effects of increased protectionism. We've seen throughout history how efforts to shield industries and workers from foreign competition have been counterproductive. Increases in tariffs lead to higher inflation and a stronger real exchange rate, as well as potentially higher interest rates. And work done at the Banque du Canada shows that a broad-based increase in U.S. tariffs would ultimately lead to lower U.S. output after about 5 years, whether or not other countries retaliate with trade policies. Basic economic theory also suggests that increased protectionism leads to slower productivity growth, slower rates of innovation, and technology adoption. But while it's one thing to make theoretical economic arguments about the benefits of open trade, it can be a lot more helpful to have concrete examples. So let's consider the auto industry. Well, we could talk about how the auto industry is responsible for 18% of Canada's goods exports, about 30% of Mexico's. We can talk about how many times a single auto part might cross a national border during the production process. We can talk about the intricate supply chains that have been developed over more than 50 years. Or we can show how building a single integrated North American auto industry has led to jobs in all 3 countries. The Automotive Parts Manufacturers Association has done a good job of putting these numbers together. In Canada, 81,000 people are employed in the automotive supply sector by both Canadian and foreign-owned firms. Those Canadian companies operate 150 plants in the United States, employing almost 43,000 American workers. And they have another 120 plants in Mexico, providing jobs for roughly the same number of workers in Mexico. Now, it's very hard to imagine how interfering with open trade or implementing other protectionist policies would benefit these people and their families. Now, it would be helpful to hear many more examples from other industries. Policymakers, business leaders, and labor leaders all have a role to play in showing how open trade has meant jobs for workers across North America and around the world. Nobody, and I say nobody, can explain the importance of trade to an employee better than their employer. Regardless of what evolves, though, there's no shortage of potential sources of growth for both of our economies. The first order of business should be to keep working on opening trade elsewhere in the world. And in this respect, Canada has been playing catch-up to Mexico, which has successfully negotiated access to many more markets than Canada has. The numbers tell a clear story. As of today, Canada has free trade agreements in force with 15 countries that represent about 22% of global GDP. Mexico has agreements in force with 47 countries, and they represent 44% of global GDP. But if you take the U.S. out of the picture, Canada is left with free access to just 6% of the world economy, compared with 28% for Mexico. Now, the good news for Canada is that this gap will close significantly once the agreement between Canada and the European Union comes into effect. It's unfortunate that the Trans-Pacific Partnership, with its groundbreaking coverage of intellectual property and services, has been shelved for now. Still, the work that was put into those areas could prove useful for both Canada and Mexico in future trade agreements. The bottom line is that there's still scope for both countries to improve access to markets outside of North America. Within Canada, we've had the positive news last month of an agreement to lower barriers to interprovincial trade. Perhaps the most encouraging part of this agreement is that instead of listing the few areas that are subject to open trade, as in the past, the provinces are now listing the areas that are exempt from free trade, what we call a negative list. This makes open trade the default position, and it means the provinces will be under continuous pressure to justify any exceptions. Now, beyond pushing for open markets, governments can pursue structural policies that allow our economies to be as flexible as possible. Canada is taking some welcome steps in this direction. For example, by investing in infrastructure that can increase our economic potential, and by helping workers develop new skills to take advantage of a changing labor market. Now, I hope that policymakers at all levels of government will continue to focus on measures to improve Canada's flexibility. I've already spoken about the moves by the Mexican government over the past 5 years to introduce some major structural reforms. Besides energy market reforms, there's been good progress in such areas as tax policy, competition policy, and regulatory reform. So these and other measures are all investments in flexibility. They'll improve economic potential. It'll give Mexico a better chance to succeed and grow in the future, no matter what's happening in the global economy. Now, in terms of central banking, the Bank of Canada has been working on the implications of heightened uncertainty for the economy and the conduct of monetary policy. Now, fundamentally, the bank renewed its 5-year inflation targeting agreement with the government last year. After a thorough look at all the evidence, something we do every 5 years, we concluded that setting interest rates to aim inflation at a target of 2% remains the best policy for us. Amid all of the uncertainty, we can provide Canadian businesses and consumers with certainty about the future value of their money. So allow me to conclude. For both Canada and Mexico, the oil price shock represented a significant economic setback. Sound economic policies in both countries are supporting a return to more balanced growth. But now again, we face a common challenge. Even though trade liberalization and increased economic integration have generated prosperity across North America, we're now faced with the threat of new protectionist policies from our largest trading partner. We know that with protectionism, everybody loses eventually, including the country that puts the policies in place. And the uncertainty around this threat of increased protectionism is holding back growth. However, in these times, it's important not to lose sight of the bigger picture. There is much that Canada and Mexico can do to support growth and employment in our economies. We've faced obstacles before, and we've overcome them. Back in the 1860s, now here's your history lesson, the United States pulled out of a free trade agreement with the colonies of British North America, which we now call Canada. This, in fact, provided the impetus for Canadian provinces to do confederation, to build what we know as Canada 150 years ago now. And that project has turned out pretty well. The antidote to uncertainty is certainty. And the Bank of Canada will continue to provide certainty around the future value of our money through our commitment to inflation targeting. This is the best contribution that we can make to Canada's economic welfare. And more broadly, Canada and Mexico's shared commitment to open trade means both of our countries are well placed to thrive, whatever the international environment. Thank you so much.
Well, now we will open the floor, but first of all, let me welcome again Governor Poloz to Mexico. We are also delighted to have Governor Carstens, and your thoughts about seeing Canada raising the flag of open trade in these difficult times and provide certainty in these uncertain times is always reassuring. So please feel free. There are some questions that have already been given to us by some of you, but if anybody feels like putting some questions for Governor Poloz, please do so. Yes, over there, please. Hi, please. There is a microphone.
Thank you. Rather than making a question, I'd like to make a suggestion. I am delighted, Steve, if I may call you that you are here with Agustin, and that, and the two flags are with us, Canada and Mexico. And I was very upset this morning when I saw the news of the latest request to Santa Claus of Mr. Trump, suggesting that we should have, instead of a NAFTA agreement revised and signed between the three countries, the possibility that the United States would be very pleased to have a NAFTA, a free trade agreement with Canada, and a free trade agreement with Mexico. That, to me, based on my high school learnings, is equivalent to divide and conquer. And I believe to say that we should not accept such a tantalizing offer by Mr. Trump. Thank you.
Many thanks. I think Governor Poloz won't refer to Mr. Trump or any particular character, but you probably would like to address the substantive question.
Well, thank you for the suggestion. And I mean, frankly, as a central banker, my interest in this subject goes to the fundamentals of the economy. For us, it's a matter of, demand and supply creating inflation or not. And so we need to understand, well, how the supply side of the economy is evolving. And your trade architecture is a really important ingredient of the supply side of the economy. So, for example, our CETA, we call it, we expect to boost trend economic growth by around 0.2 percentage points over during the transition period. So probably for 8 or 10 years, that kind of transition. And when you're forecasting average trend growth of 1.5% because of, weak demographics and weak productivity, adding 0.2 onto 1.5 is a really big deal. Okay, that's real money. And so for us, that's why these things matter. I know that we're having very positive dialogues across the governments, and I'm hopeful that we'll work things out. Is that okay?
Sorry, yes.
Okay.
We have here a question by a student who has not identified himself, but it goes like this. What would you tell to young people regarding globalization? Are we at the end of such era? Will protectionism and conflict define the next phase?
So I think, the short answer is, I think, this is my opinion, of course, the answer is no. But, and I think it's just important to understand the underlying forces. So since they're a student, I can recommend that they do some homework, right? And so if you go and read Guns, Germs, and Steel, okay, and think about how the process of exchange gave rise to all of the economic human progress in the early times, process of specialization. And going to the process of globalization from that is just Mother Nature at work. So the ability to fragment our production processes, to increase specialization even more, not just inside our economies, but outside of our economies, is the natural step in our evolution. And globalization has shown its worth to everybody. And I know where the questions tend to come from, folks that may have lost their jobs and they think it's because of globalization. Usually it's not. It's because of technology. And so we have the capability to help folks like that to transition and to take care of. And I think that's retraining, et cetera. That's what we should be focusing on. Just go back to read Gun, Germs, and Steel and see where we'd be if we had tried to prevent globalization in the first place.
Many thanks. Over there, we have a question.
Yes, thank you very much, Dr. Poloz. In terms of surveying this room and talking to people from government and from business backgrounds, I think that the big theme on everyone's mind is the NAFTA negotiation and the vision for the future of NAFTA, of which you were asked, I think the previous questioner. But I just was wondering if you could talk about, not in the negotiation specifically, but what you see as the future of the North American integration, and also another issue, particularly from friends and colleagues in the banking sector, because Mexico has been through its own issues in terms of the home building industry and mortgage questions. If you've been monitoring the situation with Home Capital Group, and if it's something that you're worried could somehow impact your assessment of the Canadian economy. Thank you.
Sorry, can I ask everybody to identify himself or herself?
Oh, sorry. Eric Martin, Bloomberg News.
Many thanks.
Oh, so you're a reporter. So, well, on the first question, as I said in my talk, to me, what the situation presents us with is business uncertainty. Business uncertainty that was high before, it seems higher now. And so that's the sort of thing which causes delays in risk-taking, causes delays in investment spending. So it interrupts that process that I talked about, the natural sequence of recovery. And so that, of course, what the future looks like, I don't know. That's why I described it as uncertainty. As for the second question, I would never comment on the situation on a specific financial firm.
Fair enough, Governor. Here we have a question from a gentleman, Eberto Guzman, and he asks whether, as a potential investor in Canada, whether there are some stimulus or some sort of incentives to invest in Canada.
Well, sure. I mean, Canada is a very competitive environment. It attracts lots of foreign investment as it is, and I think we hold ourselves up as a good example of a business environment. Some of those surveys rank us very highly in terms of our competitiveness, and that's not just measured financially, but in a much broader kind of context. The competitiveness determination is a very fulsome and complex kind of analysis, right? So a lot of things come into play beyond what economists call competitiveness, which is just your labor costs in a currency corrected. And so, I think we have the sort of tax system and R&D type of tax environment which rivals everybody else. So, yeah, I'm not going to do a sales pitch on Canada here today. We shouldn't have to because, we're all friends.
Very good, very good. Is there any other question? Yes, please. Okay, it comes.
Hi, I'm Jose Luis Oriegas. It was a pleasure to hear you speak here. I have a question. You have what I've read about the Canadian housing market is that you have a bit of a bubble, and I was wondering whether it affects the way you're handling interest rates in Canada, and whether that affects your inflation target.
Yeah, no, that's a good question because when you think of developments in the housing market, whether it's a housing market that's become a little too hot, which is how we'd refer to Toronto. It's a fairly localized phenomenon, although Toronto's a very big market. Okay, it's the Greater Toronto area and the Greater Vancouver area both had these episodes of what appeared to be elements of speculative behavior in price determination. In Toronto, sort of 30% price increases. Fundamentals are very strong in those economies, And so the demand for housing is legitimately rising because of population growth, job creation, 5% sort of job creation. And supply constraints mean that you get higher prices. Supply can only keep up so much. So you have the ingredients for higher housing prices, but no fundamental can describe, give you the basis for a 30% increase in price in a year. So, we're pretty sure that this is not sustainable. It's certainly not sustainable by any of the models that we've got. Now, how does it affect monetary policy? Well, first of all, we consider this a financial stability issue, because what comes with it is rising household debt, because in order to buy those houses, young folks are taking out mortgages that are 450% or higher of their income. This is a lot of leverage. And even though we've put in safeguards to ensure that they need to qualify for mortgage at higher interest rates than they will actually have to pay, these are new rules just introduced in the last 6 months or so, that will, over time, we think, help build further resiliency into the debt structure of the economy, and perhaps moderate, so this is what we call a macroprudential series of changes, separate from monetary policy. Because, of course, it would be very odd to use interest rates to try to influence something that was going on in one city. The rest of the market is operating completely normally. And if you're an investor flipping houses, if you think it's going to grow up by 20% or 30%, if the Banque du Canada rate was 50 basis points or 25 basis points higher, that's not going to change your analysis of the situation, is it? So it's more of a psychological thing. And so we're hopeful that these other macroprudential moves that the government has put in place will help to calm that down. And financial stability concerns are firmly on the table when we discuss our interest rate policy, but that's really why we have what we call a flexible inflation targeting environment, which means if we were really concerned about something, we could take a little longer or go a little faster depending to get inflation on target, depending on what the financial stability backdrop was. But that leaves inflation targeting as our primary mission, and we don't deviate from that. That's why we need a separate instrument to control those things.
So,
Aquí.
Agustín Barrios Gómez.
I actually have a brief follow-up question on that. I have a commercial real estate investment fund. Just a brief follow-up question because it has to do with the basic economy. I have a commercial real estate investment fund in North America, and Canada is a place that we've looked at. And I've found staggering prices across the board, not just in housing, also in commercial real estate. And I've been amazed that it's not just in the Greater Toronto Area, the GTA, or in Vancouver, but even places where I expected better prices like Alberta and stuff, where you expect that the economic fundamentals have changed a little bit because of the oil market. And so what I saw was massive amounts of foreign investment, but also the fact that Canada is not expanding its urban areas as quickly as possible. And I think that now that Canada is sort of the adult in the room in many forums where advanced economies are represented, if Canada is not taking the gauntlet with respect to stepping up to becoming that newer, bigger, better place that some are calling it to be.
Next question. No, seriously, next question. Okay, so very briefly, I don't know how to answer that question. But I mean, seriously, I mean, I think you mentioned, I mean, it's obviously, you're talking about commercial real estate. So if I went into Calgary, I'd expect to see a long process of adjustment down. It doesn't happen overnight. The vacancy rate has skyrocketed, so, prices take a while to adjust. So that's because of the oil price shock, So whereas when the oil price shock happened, what happens is, as I was describing, basically the force of growth that was there in the energy sector before gets shifted into the rest of the economy, and that makes growth in places like Vancouver and Toronto even faster. and it attracts more people, both internationally and domestically. So these drivers are very real. They are making both residential and commercial real estate more expensive. You know, I don't know, I'm in no position to judge whether those prices are, you know, on what basis, the levels. I'm much more preoccupied with the rate of change and knowing that the changes that we've seen in residential in particular are not sustainable. That wouldn't, you know, that doesn't mean somebody doesn't buy a house. If they know they want to be there, you know, they're afraid of being left out. All right, so if it continues, well, they may get left out, so they still buy. And I say to them, well, if your intent is to stay there, and you know, if the price fell by 10% or 20%, you just continue paying your mortgage. That's okay, right? But if you're flipping houses, that's a very risky business when the backdrop appears unsustainable. Right, so.
Many thanks. One more over there.
Armando?
Sí.
My name is Eugene Madero. I work for a company called Rossini. First, I want to congratulate you for being here. It shows a lot of presence.
Thank you.
I have had a long relationship with Canada because I studied in Canada, but most importantly, I buy a lot of steel from Quebec. You used to be my banker, so thank you for showing up here.
Yeah.
For the Export Development Corporation.
Yes, right.
I think we're one of the companies that buys the most from Canada today. What I want to tell you is I saw are very absent, the Canadians, the last 2016. Recently, you have come back. This year so far, me or people from my company have met with Champagne, the Minister Champagne, Freeland, Foreign Secretary Freeland, Undersecretary Sargent, you today. So we're very happy to see this. For us on the news today, it's very important that you stay together with us in Mexico and do the trilateral thing. That's my message to you, so you take it back to your colleagues.
Okay.
You have to be our wingman, or don't leave the formation, okay? Because we will be weak. And you too, so it's better to stay together, all right?
Okay. Thanks.
Thanks.
You for this. Thank you for your suggestion.
Hello.
Okay.
Anthony Esposito with Reuters, another reporter. You mentioned the next 10 years. I'm wondering if in the scenarios you guys have written up, if the U.S. rips up or scraps NAFTA, what the impact would be to GDP or trend growth. And an additional question on the housing market, if there's a fear that there might be contagion, considering that there's been a loss of confidence in mortgage lenders. Thank you.
So on the first question, we have not, our best analysis is put in our monetary policy report and the research reports that back it up. And we have not done a fulsome analysis of any proposed changes to trade architecture, basically because there's such a wide array of possibilities, which are very complex to analyze, and which, you know, would just be, we just need to wait and see what actually gets proposed. And then we can use some models to give some insights. Importantly, models will give insights at the macro level. Those insights vary a lot from sector to sector, company to company. And so that'll be very important to keep in mind that as we go through this, it won't be the same for everybody. It's a very, very complex question. So not easily just quickly do a thing with your model and say, this is what will happen. We won't do that because it would be irresponsible. As for the second question, you know, obviously the housing market in Canada is one of our top risks as laid out in our financial system review. That the household indebtedness and the imbalances in the housing market have been a preoccupation there, and I don't really have anything new to say about it today. But that is our headline risk in the FSR, and there'll be a new FSR in about a month. Yeah, about four or 5 weeks. I forget the exact date, but early June. So we'll have our update then.
Fair enough. I think we close. What a great luxury having here two distinguished governors And we take this opportunity to start saying goodbye to Governor Carstens, who will go to Switzerland in some more few months. And Ambassador Allary, if you want to close the session.
Well, I just wanted to.
Sorry, just an applause.